All right, let's bring in our markets panel now. We have Gary Rand. He's the founder and chairman of Telemus Capital Partners. And Mark Martiak is the senior wealth strategist with Premier Wealth First Allied Securities. Gentlemen, good to see you. Mark, you think we're going to go over the fiscal cliff. I happen to agree with you, or at least I think that some people actually want that to happen. But you have to advise your clients in a certain way. If you believe that we're going off the fiscal cliff, what do you tell your investment clients to do?
Well, currently, what I'm advising my clients is to accelerate their income right now and defer deductions based on strategies that we're having, discussions we're having with my clients and their accountants. I'm also telling them to be very defensive. Our baseline scenario as we head into the new year is for slow but steady growth, coupled with low inflation and reasonable and attractive valuations of equities.
Now, Gary, let me get you to respond to that outlook, because I understand you're more positive on the market because of the cliff.
Well, I think, everyone seems to be mesmerized by the discussion about the fiscal cliff, but the last time I checked, stock prices were usually based on earnings outlooks in the economy, and we see both improving. But that's the issue. Everyone's ignoring the fundamentals right now. Yeah, exactly.
When can we get back to the fundamentals and ignore politics? If ever a time in the future.
Well, maybe when we start talking about the Super Bowl ads versus the fiscal cliff.
I'll tell you.
I think,
you make a great point. Carry on.
I think at some point, we'll solve the fiscal cliff. We'll either kick the can down the road, we'll have a grand bargain, we'll have no bargain, but it'll be old news, not the current news.
Mark, we're going to be talking about the retail sector coming up in more detail, but we're getting a lot of mixed signals about what's happening in retail in this holiday season. What are you sensing about it?
I think the retail sector will perform well. I just don't think it will exceed analyst or Wall Street's expectations. I think everything that needed to be done in terms of consumer investments purchasing in the aftermath of Sandy took place. On the other hand, if you notice, there haven't been a lot of promotions out there from the major retailers past the holiday weekend that kicked off this season, that is the Thanksgiving Day weekend. So I believe retail will do reasonably well. The question is, will it exceed last year's performance?
Speaking of retail, Gary, I know Apple is one of the companies you're bullish on, even though shares have come down $90 of late. Where's the upside? Where do you see this trajectory?
Well, I have three sons, all in their 20s, and they're married to the Apple ecosystem for, I think, years to come. And, I think Apple is a play that it's not going to be the Sony that people talk about. I think Apple's got a place in the public's mind that's going to be tough to remove.
So with the recent declines, is this an entry point around $5.20 a share?
I think if you back out the cash, the stock's trading, 8 or 9 times earnings, depending on who you're looking at. And I think, given its outlook and I think the demand for not just the U.S. consumer, but, now you talk about phone sales in China, for example, just started on the I-5. I think there's a lot of catalysts, and I think the stock's cheap.
And Mark, despite your pessimism about what might happen in the economy, you're optimistic about what's happening with home builders. You think this is a real burst that we're seeing here, one that'll last?
I agree. The trend line points to home builders enjoying a nice ride, and you're seeing that it was priced into the market probably about 2 quarters ago, but it will continue. And I think that that part of our economy will help not only the home builders themselves, but investors that are in the market.
By the way, continued for how long, Mark?
My sense is throughout 2013. I really think that you can really count on this resurgence from the home building sector.
All right, one last comment from you, Gary. Mark, sorry I didn't get to ask you any direct questions, just the way it all sort of unfolded this hour. But Gary, remaining time here, what's your preferred asset allocation?
Right now we're allocating, so a model balanced portfolio at Telemus would be about 43% equities that would be split equally between domestic and foreign. We're about 15% traditional bonds. We're about 30% non-traditional bonds. We like credits like junk and mortgage REITs. And we're about 10% real assets. That would be energy, MLPs, precious metals, and we're about 2% cash.
Great detail. Thank you, gentlemen.
Mark Martiak and Gary Rand, thanks to both of you. Appreciate you coming in.
Thank you for having us. Happy holidays.
Likewise. Back at you.